Okay, so I have a position here that I put on yesterday after I saw, or rather, I noticed a large jump in the price of Tesla, which in turn brought some volatility back into Tesla as well. Tesla's volatility had been sapped over the past few months, and one indicator that you can use to tell you when the volatility is going down is, of course, the implied volatility itself. You can also use the average true range. When the range of a position begins to decrease over time, so let's say the average true range, which is the average range of price that a position goes through on a daily basis. So let's say that in January, Tesla's average true range was about 80 points a day. So Tesla could potentially move, or it had moved on average about 80 points per day. And if the average is 80 points per day, and then over time, that average range that Tesla moves or fluctuates goes to 20 points per day, what does that tell us? That signals to us that the implied volatility is going down. But like I said, you can literally just look at the implied volatility and confirm that yourself with an exact number. And so the lower the implied volatility, the less option prices are worth. And also, the less they were fluctuating. I had a position on, it was a 14.25 call that I bought, and a 17.25 call that I sold, and both of them were for the expiration June 2022. So the position ended up being a debit position because the 14.25 call was a debit position that's more expensive than the 17.50, I think, was the strikes call. And sorry, I'm going over a bridge. Okay, so despite this, I mean, this was a debited position. It would not move much during the day, and the reason is because, like I said, the volatility was so low in Tesla. And so Tesla wouldn't move much in the underlying, and the value of my position wouldn't move a ton during the day as well. So when I see this huge spike, and look, it's funny, I also had a put debit spread on Tesla that expired in maybe August or June. I can't remember what the exact date was, but either way, I had a position on a debit position that I wanted so I had two debit positions, one debit call and one debit put. So both of them, I was banking on an increase in the volatility of Tesla to increase the value of the positions that I put on. And yesterday, that increase in volatility came because even though the stock went up, this is going to blow your mind, my debited puts benefit when the stock price go down. My debited put actually increased in value yesterday. Big surprise from the previous day. So the day where there wasn't any volatility to the day that there was quite a bit of volatility, even the put position, it moved against it, and the put position still had a positive day-to-day change. So from that point forward, I said, okay, I can close that position. And then the following day, so really the day was, let's say today's Friday. So the day was Wednesday, the 23rd of June. So Wednesday, I had my days mixed up because Wednesday I closed that put. When I saw that the volatility was holding on Thursday, I said, okay, now I'm going to close the call spread. I really only closed the call spread because E-Trade was annoying me. But anyway, after I closed the call spread yesterday, I opened up this position. And this is an iron Condor. And basically, because that volatility increased so much, I wanted to sell something because these two positions that I put on have a 65% chance of maximum profit, a 65% chance of success by expiration. And So in other words, the odds are in my favor, and I basically put on a position that stands to benefit if Tesla stays between a very specific range, and that range is $625 and $740. That's the range that I need Tesla to stay between, and this position will be a maximum profit position. Now, the most that I could lose on this position, I want to say I collected $600. So the most that I could lose on, actually, I might have collected a little bit more than that, $605. So I collected $605. The most that I could lose on this position is $395. I get that number from my iron Condor, each of my correlating strikes. So in other words, both of my puts are 10 points away. Both of my calls are 10 points away from one another. So with it being a 10-point wide spread, the maximum value of positions that are 10 points wide from one another, remember, they have to be the same. So either two calls or two puts. The maximum amount that these two can be worth is $1,000. So if I get 605 for it, the way that I calculate the most I could lose is the difference between that 605 that I already got and the $1,000, which is the maximum that these two would be worth at expiration combined. Because remember, I'm looking at this entire thing. It's 4 different contracts, 2 calls and 2 puts, but it's essentially still just one position. This is considered one position, and with these 4 and the way that I structured it, this is called an iron Condor, and it's just 2 vertical calls spreads. 2 vertical call spreads, and these call spreads were credits. And it's also, it's 1 vertical call spread and 1 vertical put spread, and both of them I took credit for them. So in other words, I sold them. I collected money. I sold it to someone else. I sold it in the market. So I stand to benefit if it stays right in between that range that I specified, $625 and $740. I know that was probably a lot of information. Only 1 day has passed since I got the position. I'm positive just a little bit this position is collecting about $4 per day. But as I get closer and closer to expiration, because this position is 43 days till expiration, or 42, as I get closer to expiration, that amount will pick up so long as Tesla stays right in between that range. So I got a decent sized range. It's not huge. So, I may have to maneuver just a bit, but right now I'm just leaving the trade and not bothering it. Okay, I know that was a lot of information, but I hope it helps somebody. Sorry for talking so fast, but I just got off of work, and I like to get straight to the point. So I hope this helps somebody. Sorry if it was a little bit longer than my normal videos. All right, guys, take care.